it's good to be real about your deals, right? Like the biggest thing is like we've seen a number of deals lately do like 6% cash on cash, 7%, which I mean that's not that common, and that's not even that great for other cash on cash metrics people might be able to meet, but you're getting the equity growth, you're getting the mortgage pay down as well.
Yeah.
And those are deals with upside.
Yeah, and deals with upside.
Right.
I think
those aren't turnkey. Like those are
the biggest
value add
concern,
plays technically, right?
The biggest concern in the market right now is there really is no passive appreciation. Like just
Well, there
As
is,
of right
but
now.
you can't bank on it in the near term.
Correct.
Like you're looking 10, 15 years out and saying, yeah, prices should be higher.
and that's the way you should be buying real estate right
Yeah.
now, right?
Yeah.
Because again, right, like I still see people come out with the 3 ways to win, whether it's on the Keyspire format or whatever, and they're running like 5% on passive appreciation. It's
Yeah.
like, in what world?
I've been hard on 1% for the last while.
I was running negative for a little while on my buys. I was literally like,
why
hey,
these sheets
your
don't do
value
it.
is going down,
Right.
but don't worry because we can beat them on the rental increases. Like you're
If you have to build in the appreciation side in today's market to deals, you don't have a deal.
Welcome back to REI Hot Seat. Andrew Hines here with David Hulshof and Jacob Campagnaro.
Hello,
and
hello.
We're going into a deal in Minto today.
Minto, yes.
Minto
Near
of all
Walkerton.
places. Near Walkerton. So
Bruce
in Dave's playground of the Bruce Peninsula, near Bruce Power.
Yeah. I do get phone calls now with people being like, hey, you're the guy who's so bullish out there.
You're the
That
Bruce
helps.
Power guy.
You're the Bruce Power guy, yeah.
Yeah, the Bruce Power guy. So yeah,
cool
Dave,
with
high
that.
level, what is this? Like townhouses? Is it stacked? Is
Yeah,
it,
so it's not our listing. It is on MLS, so 103 King Street in Minto. These are unique towns. We actually sold 20 of them in Paisley, Ontario, and they were exact same layout. So you walk in, there's a landing, stairs go downstairs to the bedrooms, and then upstairs is your kind of hangout area, kitchen, all that fun stuff.
Okay.
So one of the side notes for these, because we looked at it for the Paisley one, sometimes with townhomes, you can actually go through the process of separating them and making them individual.
Like condoing them.
Exactly, and then selling them off. For styles like this, doesn't work because there's so much below grade, right? So the actual technical square footage is above grade is like 250 square feet,
Right.
300 square feet. So you're going to struggle to finance them if they were individual condos.
Because the below grade portion is like a raised basement. Is that right?
Yeah. So you walk down below. Yeah. So, anyways, that's not the play here. It's just a fun little side
treat it
story
like-
because we went through quite a due diligence process on
Okay.
another one. So I happen to know the layouts very well.
So treat it like a true multifamily then. That's not a play.
Yeah, that's not going to be the move here, but it is in some other deals, which is cool. So
Okay. So we can see that on the screen. It's the
yeah,
realtor.ca.
they're nice units. I mean, I'm pretty bullish on all things townhomes. Pretty much everything's metered. I think we'll check on the numbers. Nicely done. So standard.
Standard.
beautiful.
Standard.
That's all right.
And these are usually separately metered, all these ones,
Yeah,
right?
yeah. So here, let's just jump. Let me
So
see.
8 units. So.
Yeah, they are separately metered there, everything.
Yeah.
So not dissimilar to the Walkerton and the Paisley one, where water, hydro, everything's
Yeah.
metered.
So then I'm interested. So we have it up here because we talked about in an episode not too long ago, and I don't remember if it was just Andrew and I or if you were here, but we were talking about operational expense ratios and like what your typical OpEx ratio would be
yes.
and how to quickly analyze. So we talked about the typical multifamily OpEx ratio. Being around that kind of,
Yes.
we called it 35 to 40%.
Yeah,
right.
30 to 40 range.
It can be
right?
less. It can be 30,
yeah.
35, 40. But I'm curious about these towns, right? Because you've sold a number of these towns
Yes.
now, and I'm just.
Can we
I'm very-
guess? Can you guess?
I'll
What do you
guess.
think the
I'll
OpEx
guess.
Expense ratio is going to
Now,
be?
wait,
Yeah.
before you do, let me show you the rent roll. 'cause
Yeah, we
that's a
kinda need to see
factor.
the rents.
So the rents are pretty depressed.
Okay.
I filled in the vacancy at market because it is good
But the
enough.
expense ratio is still going to be good because the utilities are.
Yeah.
are
I'm going to say 27.5.
Ooh.
Yeah, I mean, I'll say 30.
30. Okay. Wow.
35?
35. Oh, so it's higher. Okay.
Yeah.
39.
Oh,
That you were
39.
being
I
a little
can't see it,
aggressive.
sorry.
39.
Oh, okay. So I'm looking at a small screen in the distance here.
Yeah,
we
yeah,
need to
here,
make
let me-
that bigger.
You know,
but-
thinking about it, I think
Yeah.
I think Walkerton was 27.
Well,
and that
you
was
know, and the
completely
big reason for
stabilized,
this
right?
is-
no, that was- yeah. Okay, so I kind of cooked you both there because yes, that's exactly it.
So two competing factors here. Obviously, the low rent roll means
Yes.
that the expenses, which are, if you break it down, your electric bill is no cheaper regardless of the rent price.
Right.
So
Yes.
so this is what people need to wrap their heads around, is that the expenses are sort of a fixed number. So if you take them as a percentage of the gross rents collected, it'll be higher or lower depending on how high your rents are. So that's the thing here. These are low rents, which means your expenses look high, but if you can raise the rents, your expense ratios should go down.
Yes. Yeah. You capture a lot more of that upside, the delta between the market and the current, because you're not,
Yeah.
right? There's no expenses in that category.
But the other factor that would be making the percentage look smaller is not paying electric, not paying water, not paying gas,
Yeah.
all that stuff. That does save. And
Yeah.
this is a very efficient, low expense ratio type of asset when they're walk up. Everyone can walk straight into the unit. Of course, maintenance-wise and life cycle maintenance-wise,
Yeah.
there's a lot of roof to cover.
Yeah.
There's
Yeah.
a lot of building exterior versus a square building.
Also, like if you really dive deep into the rents, most of them are very low. All right, 600,
Yeah.
800, 700, 700, 8, 7.
Yeah.
So I think that's probably
It's driving
right?
that up a little bit.
Do you want to make that a little bigger on the screen?
Oh, is that why you were off on
go
the
beyond
numbers?
100? Well, yeah. Usually it zoomed in a little. There you go.
There, is that better?
I mean, this is like a 13-inch screen I'm looking at. That's 10 feet away.
A couple more viewers, we'll get a bigger
Yeah.
one. Yeah. So we
Yeah, if we get our subscribers to
Yeah. Get to 2,000. We'll
2,000, we're gonna buy a new TV.
so listing price 1.4 million. Very good agent on this. We do deals together. We all like each other. Him and I were having good conversation about 1.4 is just certainly too high, and it's always the conversation of where we are in the market. Jake, I'm sure you'll appreciate the buyer side, the sales side.
Yep.
There's a lot of abundance of opportunity out there. We have some really well-positioned buyers, and really, it's just a matter of we're earmarking 3 or 4 deals and just saying, hey, this is the number we like it at, this is the number we like it at, and who's going to kind of put their hand up first.
Yeah, and just some feedback to the buyers listening. Put the offers in, guys. That's the one thing I find in this market as more of the sales side, the seller's agent, is we want to see offers. Yeah. Even if we don't accept them, we want to see offers, because as a seller's agent, bringing offers in to present helps me with, number one, it shows credibility. Hey, I'm working. I'm here. I'm hitting the streets. I'm making things happen. Yeah. And number two, it helps seller expectation. Sometimes you have that argument with the seller, which is you show them the evidence, you show them the facts, and they go, well, no, because mine's still worth more, right? So then my feedback at that point is usually, okay, well, let's try it.
Right.
Let's go out. Let's see what we can get. We can't get your price in 30 days. We're going to go take my price that I told you about, or 60 days, whatever the math is. So don't be afraid to put these offers in, right? Even if the agent comes back and gives you, an earful. Yeah. I personally find it very helpful. And eventually, if that building isn't selling and you keep putting those offers in, there's going to be a number that works there, right? And it might be on the 3rd offer, the 10th offer, or you don't know. But anyways, that's my rant for today.
We were even talking about it before. Is one of the agents on our team putting out an offer, and putting a 3-week irrevocable on it.
Yeah.
Right. Just here you go, and
here it is. Let it sit. Yeah. Right. Go explore. If there's nothing better, this is here. Please work with me. If not, I get it. Thank you.
Yeah, right. It works well. So, and it's interesting now. The way I'm looking at deals is, let's say that, and we'll run through the numbers. But let's say it's, compelling at 1.2. Let's say we're not going to even go to 1.2 because we have to price in that there's some changes in the market afoot, and there's opportunity out there. So we're trying to forward price a discount off of where we think it makes sense, and we're taking a discount off of that. Right?
Are you saying that you're projecting a stagnation or further decline in pricing?
If I'm on the buy side, that's the discussion, certainly.
Yeah, I mean, that's just conservative buying. Yeah.
Right. I think especially now in a buyer's market, you can make those calls. And if a large portion of our buyer group are sitting on money ready to transact, but at a deal that if I phone them with a deal, they need to be knocked out of their chair with excitement. And those deals are out there.
Yeah.
Right? You just have to create them. So I ran it at 1.1 million. I'm not saying they're going to sell it for that. It's just where we start to really like it. That's 137.5 a unit. That's 5.5 cap. If we take it direct to CMHC, I'm going to zoom out here in just a moment. Probably too small for you guys, but I'll run you through it. This is at, sorry, let me go back for a second. This is 1.1. So at $1.1 million or 320,000 cash to close, we can go to probably 80% loan to value. Maybe squeak it out a little more, 81. So 81% loan to value at 250,000, 4.5% interest. The challenge with where we're hitting roadblocks is the cash on cash.
And you came up with that 81% based on the DSCR, right?
Oh yeah, sorry, went a little quick. Yeah, the debt cover ratio. So if I go back to 75%, you'll see that it's 1.3.
So you just need to be above 1.2?
Yeah,
Okay.
assuming you're going to go on a 10-year with CMHC, which most people are right now. So
Okay.
Can get in the weeds, Jake. You know this. If you're getting a 6 unit, in some cases you can go to a 1.1 debt cover. There's some really cool stuff.
Yeah.
Mixed use.
1.1 that's through CMHC as well?
Yeah.
Yeah.
They like 6 units better?
No, it's just they use a 1.1 on a 6 unit because it's the like there's no economy of scale there. That's the problem with the 6s is you look at it and you're like, okay,
Your expenses are still
your
high.
expenses are
relative.
still higher compared to 6 units. So your
Yeah.
OPEX, speaking of OPEX, tends to be higher on a 6plex.
Right.
And so I think CMHC's recognize that and they say, hey, we're going to give you the 1.1 on a 6, help you out with that,
Yeah.
because at a 1.1 it's still going to debt service, right?
Yeah.
And usually the loan amounts are a little smaller, so less
Yeah.
risk, right?
Yeah.
There's a lot of reasons,
Yeah.
but no, historically CMHC doesn't like funding 6plexes.
No.
Right?
No,
It's
they
just
don't.
there's not, and then the brokers don't like doing it because there's
a
not
lot
enough
of
meat on
work.
the bone.
Well, this is
So-
here's in the weeds too. To that point, like we're using a 4.5% interest rate, which by the way, bond yields went up yesterday. I don't know if you saw, so
Yeah.
that might need to be adjusted. Just as a caveat. So one of the things we're using 4.5. If you have a smaller loan, we're going to need to build in more spread because of the brokers and the lenders. They don't want to. For the same reason, right? They're going to put a whole lot of work in. It's going to be the same amount of work, presumably, of a 6 unit as a 100 unit, right? But they're
Yeah.
not going to get paid as much. So that's where, if you look at a 4.5% interest rate, if we're doing a 100 unit deal, that's probably a little bit high because we're building on spread. If we're doing a 6 unit,
Yeah.
frankly, even an 8 unit right now with where bond yields are, we probably need to increase that because of the
Yeah.
spread. So you have the bond yield and then you have the spread between them, and that's your rate. And that's, the buffer that we're building on this.
Nice. Okay, so I had a thought. It's kind of escaping me now.
It's contagious, yeah.
It's contagious. Okay, no, we'll carry on here. I do have some closing thoughts that I want to get to, but we'll wait on that.
Yeah. So you can see, though, here's the challenge, right? You buy it for 1.1. Your capital required is quite low. So there's a good small barrier.
What are you
to
all
entry.
into the deal on this one?
260 grand.
So 260 to get in, and is there a stabilization play here, or it is just?
So here's the challenge,
Turnkey.
right? And this is why this deal is a little bit of a hard one to sell, because I understand what the agent's saying and its value from that side. However, you deploy 250 grand direct to CMHC, your cash on cash is 3%.
Yeah.
So we were sort of stagnant, right? And you're
Yeah.
beholden to turning tenants, and
But this is at your proposed sale price.
this is at 1.1.
Yeah.
Yeah,
That's
not
hard,
even-
right? Because that's you can.
I mean, there is a chance that they turn over some units. There's 8 units there that could turn over and start. The rents
Well,
would come
there's-
up a bit.
Well, yeah, there's two ways to look at it, right? And I was going to say, it's nice because if you can get that cash on cash return to a point where you say, hey, I'm comfortable to sit here and hold this.
Yes.
I don't have to do anything, right?
You're great.
Then you have all that upside, right? 1 unit turns over. Let's do the math quickly, if you don't mind.
Right.
Right. And this is the way I always like to look at things. I go, okay, so if you take one of those $600 a month units, and those went to what?
Here,
What do you
let's-
think it is out there?
Let's go.
17,
Let's grab
18?
this one right now. Like, so we'll do the exact same metrics. Won't change anything, right?
Yeah.
81% loan to value, and let's just pick this guy, and he's a $2,000 a month rent.
What's your cash on cash return? All right.
Changes to 8.7.
Yeah. There you go. 1 unit.
One.
Yeah. And now
the
that's
power.
Now that's
So
better
you
than a
tell the
GIC.
story. I mean, and those things are all like so under rented, right? Like all it takes is one, as you're saying. So I mean, I think that that's enough of a carrot for a buyer to know, hey, you know what? Reasonably, in the next couple of years, one of these is going to turn.
Like, would I buy this negative cash flow hoping a tenant moves? Absolutely
No,
not.
but it works as is.
Jake, that's a great point. So let's put in, because again, this was all predicated on 1-1. So you see why 1-1 starts to make sense. You're 3.5% cash on cash, but you're cash flowing neutral basically, and your
minimal cash in, which is nice. Yeah.
But now if we go to 1.3, the list price is 1.4. So let's put 1.3. You know, you start to see how this becomes, I don't know, maybe 68%, 69. So now you're $500,000 in, right? You're 450,000, and you're a 1.6 debt cover.
Yeah.
That's not a deal.
Yeah.
Right? And this is the challenge. So the immense amount of upside, you hit a home run off of 1 or 2 tenants turning, which on average you're what, 10% a year? So you're, 0.8, 2 years, it would turn 1.5, 2 units.
Yeah. And that's it, right? And in a town like that, what's the tenant profile? It would be my next question.
Yeah.
Right. So as I'm
Bruce Power employees.
but I mean, what's my tenant profile in the building existing?
Right.
Yeah.
Right. Elderly.
Yeah.
Lifers, long-term tenants, are they retiring here? Are they what that would be a very big factor for me to be interested in this building or not, right? Because location, I don't, you know this, we're pretty bullish in the tertiary market, so location wouldn't scare me as much as maybe others. I would say, cool, like the location, fine. I got property management out there, I'm going to do my thing, great.
Yeah.
But what are those tenants? I would ask to get into every unit. I'd like to meet the tenants if possible.
Yeah.
Because if they're all elderly, let's call it, retired or older, they're not going anywhere, right? That would be my...
There's nowhere they can get anywhere comparable cost
to that rent, right? If it's... Sorry, go ahead.
Well, I mean, the Port Dover deal that we did, which we did on the show a couple weeks back, that's under contract. Very, it's an elderly population. When we went through the tour, they're all there. Lovely people. Side note, every bed made like crazy. There's a lot, right? It's one of those, okay?
There's an upside to it as well,
well,
right?
It's like a, respectfully, it's like an old age home almost, right? But you start engaging with the tenants, and turns out that 3 or 4 of them are on a waiting list for an actual old age home. One of the tenants happens to be in the next 30 days is leaving, and we're able to actually before even firming up, broker a deal where one of the lower paying 2-bedroom tenants is going to go into the newly vacant unit, and we're kind of moving pieces around. Everyone stays, and then that new 2-bedroom that we just unlocked is going to get rented. So the cash on cash on that deal now is like 11%.
Yeah.
So to your point, it's just elderly isn't a bad thing.
No.
It just, you have to understand, like we had somebody wanting to buy a 6-unit completely comprised of 50 to 60-year-old single ladies. Not a good deal. None of them wanted to leave under any circumstance because that was their place.
Right.
Right. And they have a long runway before they go.
Right.
So.
Right. Yeah. No, it's a great point, right? So I think tenant mix in this case is very important, as we know.
Huge.
Yeah.
Have you
toured this building yet?
No, I've not been through it. If we can come to terms, I mean, I don't think we're doing a deal below, like we got to be at 1.1 for this, 1.15 maybe, and I don't know if they're going to come there, but you start to see like at a 1.3 price, it's just we don't have a deal here.
Yeah.
So.
And it's pretty.
It's good to be real about your deals, right? Like the biggest thing is like we've seen a number of deals lately do like 6% cash on cash, 7%, which I mean that's not that common, and that's not even that great for other cash on cash metrics people might be able to meet. But you're getting the equity growth, you're getting the mortgage pay down as well.
Yeah.
And those are deals with upside.
Yeah, and deals with upside.
Right. I think those aren't turnkey. Like those are the biggest value add plays technically, right?
The biggest concern in the market right now is there really is no passive appreciation. Like just
well, there is,
right
but
now.
you can't bank on it in the near term.
Correct.
Like you're looking 10, 15 years out and saying, yeah, prices should be higher.
And that's the way you should be buying real estate right now, right? Because again, right, like I still see people come out with the 3 ways to win, whether it's on the Keyspire format or whatever, and they're running like 5% on passive appreciation. It's like, in what world?
I've been hard on 1% for the last while.
I was running negative for a little while on my buys. I was literally like, hey, your value is going down, but don't worry, Because we can beat them on the rental increases. Like you're
if you have to build in the appreciation side in today's market to deals, you don't have a deal.
To try to make it work,
There's
right?
none of that in this sheet. You don't
and
need
it's funny, like if you work with some agents that are less experienced, right? Like you, for some reason, that passive appreciation line just becomes, oh, this is how I make the deal work at this price.
Yeah,
It's
you
going
throw
to be
something in
a
there.
3.257 passive appreciation. It's like, what are you talking about?
Well, the thing
Like,
is like
it's great.
historically on a 10-year span, I agree, and I can understand. This is my private wealth days. I understand the argument to needing to put something there and to do it based on historical data. But like, if we're using this as a filter and we can just find out the deals that make sense without it, why include it?
In fairness, it's tough to see exactly where things will go, but in the long run, it has to appreciate.
Correct.
Because cost of building isn't going down. So if Canada economically recovers, then real estate has to go up.
Yeah, and my only argument is just that we're looking at a year in a glance. That's what this is. Right?
Oh yeah, in
This
the next
is-
few years, you sure don't want to be, counting on that. And in my U.S. business, like anytime we're looking at keepers, we're negotiating seller financing, and I'm telling our team, like, go minimum 7 years, because I don't want to be renegotiating a mortgage in 5 years from now. Like, I don't know where things are going to be in 5 years. They could be great, but I'd rather buy myself 7, 8, 9, 10 years so that I'm in a different market at that time. Hopefully we've gone up in value and I've paid off more of the existing VTB seller finance.
That's why these style of deals, if you can get it right, you send it to CMHC, you've got a 10-year rate, you're cash flowing positive, even if it's not a ton, and then you don't have to do it. You just can leave it. You can manage it. Tenants turn over, and every tenant that turn over, it's like, it's a lottery, right? You fill it up, you go from 3% cash on cash to 9, and then from 9 to 14. It's like
it will go up.
and
This is one that if you have some patience, you'll see it pay off. Like you could see right here from the spreadsheet that this should pay off quite well over time.
Yes.
At
And if you want to increase those odds a little bit, you can grab a paralegal, right? See if there's something to do there. But again, that's not what I would bank this investment on. But there's little
even
tips and
the
tricks,
Dover deal,
right?
like the amount of movement that was completed just by the same stuff we've kind of talked about religiously, which is just having fair conversations with tenants. And it turned out that somebody was very keen on actually leaving. That happened. And then you start to engage with the other tenants, right? You kind of like letting them know and be part of the process has some value. And one of the guys actually lower paying tenants, like I would love it. Like I'll pay market. Can I go? I would just want that unit.
I think a lot of people are I think a lot of newer landlords or landlords in general are very scared of tenants because of everything in the news lately. Not everybody, right? But I feel like that's a common theme when I speak with clients. It's like, well, I don't even want to talk to them because what if they, report me to the newspaper or something? It's like, whoa, we're all human here, right? Let's have a conversation. One of my buildings, we actually just turned a unit. The guy approached me saying, hey, I'm having a hard time paying rent, right? And he was like, I know I can't stay here. He goes, but I also don't have money to move. And so we worked out a deal where I said, listen, go find a place. Don't pay me rent, right? We're going to accrue the rent. It's going to accrue, right? So, but I said, for the next little bit, don't pay rent. And I'll help you out with your moving cost. And let's go find you a place, right? And I connected him with somebody to find a place. Paid him a little bit for the moving cost. He moved out, done, right? But he was actually thankful at the end of the day.
And think how differently that would be if you came in and started a war, right?
Yeah.
Right.
And there is something to be said about these secondary, tertiary markets with a little bit more of that homegrown feel, right? And a lot of them are just easier.
You have a lot of proud people, or they're not going to necessarily want to take advantage. They're going to want to be fair if you're fair.
Yeah.
That's what you need. You need reasonable people. Yeah. And I think you're more likely to find it in a tertiary market than you are in a city.
I think you're spot on with that. Right?
It's a smaller community, right? If you have a smaller community, you don't want to be the guy, right? You don't want to be the guy kicking out tenants. You don't want to be the guy that's screwing around and not paying his rent, right?
For sure.
Yeah.
Anyways, I wanted to take a moment because I think we've kind of done a good job looking over the details of this deal and kind of seeing where it sits. It probably needs the market to tell it kind of where the value is, and then the deal gets done.
Sort of interject. These are the ones that, when people say there's no good deals on market, it's like you have to create them.
Yeah.
So this one we've been
This one
on
can
it
be
for a while,
negotiated,
and
right?
over time, if it's not this one, it'll be another one. Where eventually they do come down to a level where the deal makes sense, and then we have a deal.
When did people get afraid to put offers in?
We're coaching everybody, right?
Make offers.
Put it unless an
Make offers.
agent explicitly tells me not to do it.
Yeah.
we're doing it, and you're the same boat.
Okay, so next step, because we did an episode a few weeks ago. Jake and I did this one, buying industrial properties.
Yeah.
And Jake kind of went through the details, and we don't get a ton of comments, being honest, on our REI Hot Seat YouTube channel. But this one seemed to get a bunch of interest. So people mentioning that they were kind of into the industrial topic.
Seems to be a bit of a theme. Like we even had a meeting the other day, and I just came out like we just randomly. I said, "Oh yeah, we're doing a lot with the, like retail, commercial, and industrial," and everybody in the room was like, "Whoa,
yeah, the eyes lit up.
What is this?"
Yeah,
right?
the whole
It was
board lit up. Yeah.
So yeah, Kevin Tuttle mentioned. So yes, the contractual certainty is very attractive to landlords with commercial leases. You have to account for higher vacancy as they can be slow to lease up upon tenant turnover. Yeah. Definitely not wrong there, Peter Haroon. I need to get into commercial. Peter, thanks.
Peter,
for
give us a call.
Yeah,
we'll help you out.
Yeah.
Peter does HVAC as well. He's given me some free advice here and there. Appreciate that, Peter.
Thank you, Peter.
And then we had what appears to be a spam comment. I'll skip that one. And then we had Brock Rogerson. I know Brock. Brock, thanks for the comment. So absolutely more commercial, not just industrial, office, retail, even hotel. Do it all. Multifamily in Canada is dead money, or at least very slow money for the next decade, in my opinion.
Yeah. The last part of that is not the case if you're buying diligently.
Yeah,
right?
you can if you're making your deal right. If you're just treating real estate like a commodity, then sure. But I mean, if you're a deal maker, you make deals in any market.
Yeah.
Right?
Yeah, and I would say the exact same thing for retail, industrial, hotels, everything. Like you can put your money and watch it sit and do nothing in all of these asset classes. So it's about deal making. But yeah, I'm glad people are excited about that topic.
Yeah. So maybe that's what we need to do is jump into some of that.
I think having a nice flavor of that on our show, it makes a lot of sense. Responding to the market, not doing just the same thing. And I know we talk about different types of deals on market, off market. And I think that's just one more thing that for people who want to stay in Canada, because obviously there's a ton that want to keep their investment dollars in Canada and don't want the complication of going to another country. They want to find ways to make deals work here. And if that's a different asset class that's more fair, like Ontario Landlord Tenant Board sucks. Like it sucks for landlords. You can build it into your business model and you can be totally profitable. And obviously the big dogs do it. But if you want to avoid it, there's options.
Yeah. And one thing I will say with the retail, commercial, industrial, hotel, et cetera, I find there's a lot more non-disclosures that have to be signed in that part of the world than the multifam side, which makes it a little bit more difficult to talk about, right? Because we're really just bound to talk about what's available publicly. Right, we honor the non-disclosures. We have our own that we get people to sign. So we can't go. Sometimes we can't go too far into it. But if there are opportunities where we don't need to sign non-disclosures, they're comfortable with us talking about it, or we can just talk about what's publicly facing. Happy to bring some more on, and we can dive into it.
It might be good to start with, the differences, right? What to be aware of.
Yeah.
Like, just a high level, and then work our way into some of the.
Well, I think we owe the viewers a deep dive analysis into a pro forma of a retail, commercial, or industrial, because we did do an episode recently where we kind of went high level with it.
What do you call that one? Because it has the office space at the front and then the workspace at the
flex
back.
use.
Flex use.
Yeah. Flex use, small bay industrial is what we call it. And we do actually have a pro forma on that one that we can talk about, because there is some fun, cool strategies. Because again, that one, you look at it face value, you go, this isn't a deal, it's overpriced, right? But there's a lot of cool little tactics like we talk about all the time, which we can do. So maybe next week, let me prepare that pro forma, and let's sit down and hash that out.
Let's do it.
All right. Okay, guys, if you made it this far, show the channel some love. And then, of course, if you want to get the deal of the week, if you want to have connection with Dave, Jake, and the team, make sure you join the list attached to this video. It'll be in the comments section, or it'll be right below in the description, or it'll be in the show notes for the podcast listeners.
Not to forget, Dave and I filmed a very nice little intro video last week, which is going to become part of this. So when you hit that link, you are going to get an intro video from us and a few little tidbits. We'll keep it a secret, though. We're still just finalizing.
Coming down the pipe. Yes.
Glad to hear.
Maybe you can join us on some of those.
Would love to.
Beautiful.
All right.
Awesome.
See you guys
Thanks,
again
guys.
next week.